Chapter 24. This is our last chapter of the first book. So 24-1, recording international sales. We have 5 objectives. You need to be able to explain the purpose of entering the export and import markets. You need to be able to describe issues that must be considered before making international sales. You need to be able to explain the documentation that must be produced to process international sales. You must be able to account for international sales, and then you must be able to account for time drafts. Okay, so first we're going to look at the difference between exports and imports. Exports are goods or services that are shipped out of a seller's home country to another country. So that's when we are selling our goods or services to another country, those would be exports. Imports then are the opposite. Goods or services shipped into the buyer's home country from another country are called imports. So if we are buying our goods or our services from another country, those are imports. Merchandise sold to individuals or other businesses within one's own country is referred to as domestic sales. So that's what we've been dealing with before is domestic sales. We haven't talked about doing any selling or buying from outside the country. International sales compared with domestic sales. So kind of the difference. There's a lack of uniform commercial laws. There's greater distances, obviously. More complex transportation methods because we're transferring it from 2 different countries. There's also a risk of uncollected amounts, greater, I guess, than what we already have, and then an unstable political conditions. The process of an international sale, the contract of sale. So a contract of sale is a document that details all the terms agreed to by the seller and by the buyer for a sales transaction. The contract should include the description and the quantity of merchandise, the price of it, the point of delivery, the packing and the marking instructions, the shipping information, insurance provisions, and the method of payment. So that should all be included on this contract of sale. The other thing is the letter of credit. The letter of credit is a letter that's issued by a bank guaranteeing that a named individual or a business will be paid a specified amount provided stated conditions are met. So really it's just a letter from the bank saying, yes, this amount will be paid as long as the conditions in the contract are met. All right, collecting payment for an international sale. We have a bill of lading, means a receipt signed by the authorized agent of a transportation company for a merchandise received that also serves as a contract for the delivery of the merchandise. And then we have a commercial invoice, which is a statement that's prepared by the seller of merchandise addressed to the buyer, showing a detailed listing and description of merchandise sold, including prices and terms. A draft is a written, signed, and dated order from one party ordering another party, usually a bank, to pay money to a third party. So they do say that a draft is sometimes referred to as a bill of exchange. A draft payable on site when the holder presents it for payment is called a sight draft. So they may offer that sight draft showing that they do have an order into the bank. All right, let's get into our journalizing then. It says on June 1st, we recorded international cash sale of $6,000, memorandum 45. Pretty easy here. The only thing that they're doing by tricking or trying to trick us up maybe would be that they're putting in that international in there. We're just going to debit cash. We're receiving cash and we're going to credit sales. We've made a sale. Since we're receiving cash, that's going to go into our cash receipts journal. We're going to include our date. That check mark goes in there, a memorandum number, and then we're going to have another check mark because that just means that nothing will be posted individually. And then we're going to credit sales and we're going to debit cash. Remember, the reason that the check mark goes in over here is because there's no account to put into that title. Time drafts, journalizing a time draft. It says on June 10th, we received a 60-day time draft from Ramirez Company for an international sale, $7,000, time draft number 12. Now, this is going to go into our general journal. We're going to debit time drafts receivable. So it's kind of like our accounts receivable. And then we're going to credit sales because this is covering a sale. Okay, so it goes into our general journal. We put our date. We're going to debit times drafts receivable. We're putting that document number. That's a new one for us. So TD and then the number. Okay, and then we're going to credit our sales account. Okay, last journalization is cash receipts then from that time drafts. On August 9th, we received cash for the value of time draft number 12, $7,000, receipt number 465. So again, this is a lot like accounts receivable. In that one before, it's like they bought something on account and now they're paying us for it. So we're going to debit cash, we're receiving cash, and we are going to credit our time drafts receivable. We're receiving cash, so that's going to go into our cash payments journal. We have our date. We have our credit to our time drafts receivable. We have a receipt number, and then our debit to cash. Audit your understanding. Number 1, what are 4 of the issues that must be considered before making international sales? Okay, so we looked at the lack of uniform commercial laws among countries. This is going to make any settlement disputes more difficult. Number 2, there's greater distances and sometimes more complex transportation methods that is going to increase the time to complete the actual transaction. Number 3, because it may be difficult to determine the customer's financial condition and to take legal action if a customer does not pay, the risk of uncollectible accounts is going to be increased. And then the 4th, unstable political conditions in some countries may affect the ability to receive payments from those countries. Number 2, what 2 purposes does a bill of lading serve? It serves as a receipt for merchandise received and as a contract for the delivery of the merchandise. Question number 3, how does a sight draft differ from a time draft? So a sight draft is payable when the holder presents it for payment. A time draft is payable at a fixed or determinable future time after it is accepted. So in that example that we did with the time draft, I believe it was a 60-day time draft. Number 4, why do many companies dealing in international sales rely upon letters of credit from banks? To assure the receipt of payment for those sales. And last question, number 5, how does a trade acceptance differ from a draft? A draft is generally paid by a bank, and a trade acceptance is paid by the buyer. So a seller generally has much more assurance of receiving payment from a bank than from a buyer. That was the end of 21-1. You can now go ahead and go on to the work together.